G'day expats and welcome to another episode of Expat Chat, episode 167 today. And today, as always, joined by my mate and colleague from Australia, Managing Director from the APAC region. G'day, James.
Good morning, Brett. Thanks for having me on again. And for those that are tuning in on YouTube, on my left-hand side, mate, colleague, business partner, mentor, Brett Evans, the founder of the Atlas Wealth Group, Managing Director of the Europe, Middle East, Africa region. Mate, how is it over there at the moment? Pretty cool.
Mate, it's crispy. It's nice. It was
Yeah.
15 degrees last night and a bit of wind chill
Whew.
brought it down to about 10. And my daughter, who's out at camp last week in the desert, was telling me it was 6 out there. Yeah, we're enjoying it right now. I love it. Fireplaces and, sort of fire pits are going and it's cool. I love it. I love it.
And I mean, it's not as cold as New York, though. I'll
No,
say that.
no. We just had that eye-watering experience about 5 seconds ago when we looked at the forecast for next week or next month, and yeah, she's cold.
Yeah, shit. I don't own anything warm, especially if
Yeah,
I'm rocking getting around in my suit. Anyway, I'll have to go to the
stubbies
shops.
and
It's
thongs, mate.
summer here.
Stubbies and thongs.
It's
Bring
su-
your winter thongs.
and it's summer here. God damn it. There's
Exactly.
nothing for sale. But mate, what we're going to discuss today, a bit of Q&A from the Australian Expat Financial Forum. So that's our Facebook group. A lot of Australian expats in there. Great things going on within that group. But a couple of questions just to address today.
And also too, we've had a one of the listeners email us. G'day, David. So we'll run through your thing. Today, we're also going to touch on everyone's dirty topic that no one likes to talk about, but it does have relevance to expats, and that's politics. What's going on now with the coalition, non-coalition going on with Susan Lee and everything going on there. So, but mate, let's keep the compliance officers happy in the world. Let's get the jingle out of the way. All the information we're going to talk with the good folks on the call today should be treated as informational and educational purposes only. Please do not construe this as personal advice. If you do need to get personal advice, please reach out to a specialist like Atlas.
Absolutely, mate. And I mean, we look back in Australia, we look within right now, and
Oh, it's
coalition,
messy.
there's been some shit going on back in Australia the last couple of months, but
You've been busy.
um, we have been busy. But I mean, last 24 hours, or probably maybe the last couple of days, more likely, the coalition party, so the Liberal National Party, is pretty much coming to an end. We've been here before, but this just seems like the final straw that's going to break the camel's back. Susan Lee, she's gone against David Littleproud, and she's had obviously those three main senators step down. And now David Proud being the leader of the National Party, he's like just saying we can't remain a coalition while Susan Lee is the leader. Absolutely not. So I'm out. I'm going to take my party and we'll go elsewhere. But we knew this was coming, but it's more so, and what I wanted to drill down and discuss with you, Brett, is like, let's think about the snowball effect here. Let's think about the next 25 years. What does that mean?
Yep. Look, I mean, to me, it almost guarantees, Albo's got a job for the next 3 terms because
Yep.
you've got to build trust. That's why people vote. And
Yep.
when the punter sees everything falling apart on the Nationals and the Liberal Party, people go,
Mm,
yeah, do you want them running the country? Are they acting like statesmen and women? So the answer is no. So we've got the
mm,
next election, which is what, next year, potentially.
hmm
Um, the Libs can't even run a coalition at the moment with what they've got. So you can't put up a strong fight at an election, which starts a year out. Technically, everything will start to build up at this year. So Albo must be loving it. He must be sitting there rubbing his hands together going, giddy up. But what it
Yeah.
means is this is even more of a mandate, more firepower for him to push through all of his dreams.
I agree.
So, yeah.
Yeah, there's so many. I mean, you can break it down into categories. Actually, we should start with superannuation. Division 296. That hasn't gone away. That's come back. They've obviously
Yeah.
updated it. Very small consultation group on that one, but that's at the draft stage now, and they've had a refresh on that. So there you go. Labor taxing our super based on the size of the balance, over 3 million, those sort of things. So that's an example. Labor loving to tax, but I think when you look at probably the wish list over the next, call it 20 years, there's a lot in there. I mean, we could
Yeah.
see well, I mean, I'm just going to mention a few things, but franking credits, a lot of pensioners these days that have investments in shares, whether it's in super or not in super, loving their franking credit refunds when they lodge their tax returns or they see it deposited in their account-based pension. That could be going if Labor is in for the next 20 years because that's come up before. That's a proposal from them, but obviously got knocked back because at the time Liberals had the majority. Now, or I should say Coalition had the majority. Now, that's one item. I think we could probably talk about property. We could talk about the main residence exemption. A lot of people don't like the main residence exemption. Exempting capital gains on significant assets, especially if you own a property in Sydney and Melbourne and you own it for a short period, but your capital growth is a couple of $1 million. There's a lot of Australians which don't like that. So maybe capping the main residence
I
exemption
can
like
see
they
them
do in
capping.
the
Yeah,
like in
I
the
can they'll
United
cap it.
States. Yep. So there's that side of it, the 50% CGT discount concession. Now, as we know, Australian expats, non-residents of Australia, for tax purposes, they actually can't tap into that one. That was, I
2012.
suppose, yeah, kibosh was put on that one, I think as of 9th of May 2012. Um, so that's a few examples. They've previously talked about how people use family trusts and obviously trying to mitigate how you distribute income from a family trust. So, important tax planning. There's this introduction or actually the ATO's put section 100A on its shit list this year, I believe, where need to be mindful of how you distribute money out of family trusts. So just talk to your accountant if you're not across that one. Um, that's a quick example of a few things which I think will come about over the next
Negative
couple of years,
gearing,
which is a little
every
bit scary.
Australian's favourite pastime. Negative
Yeah.
gearing. Do they cap the number of properties or the value or their grandfather? Or to me, that's a big one. If
I
they
agree.
they
Yeah.
solve that, because I think I mean, to me, as an Aussie from afar, reading the tea leaves back in Oz, the anger
Mm.
is with a lot of landlords holding up properties for Airbnbs and all these sort of different scenarios. The way
Yep.
you release supply is reduce the tax effectiveness of owning 15 properties. And by doing that, I think that would actually, sort of go a long way. And I think Canberra knows that as well too. So negative gearing, no other country does it. UK did away with it, about 3 or 4 years ago. And I think New Zealand too, friends across the Dutch. Anyway, so to me, that's a big one as well too. I think that's going to really play up. And I think this year's budget in May is going to be a lot more exciting than it has been in the past.
Yeah, I think so. I mean, it'll be interesting to see if Labor is in for obviously the next couple of terms. I mean, we're always keeping an eye on those tax residency rules and the changes, so that could come back. Not to say it's going to be redesigned, but ideally they've taken all the feedback from the period of consultation and they've updated the factor test because that's the test which are a little bit scary. Um, so with that in mind, I guess we are going to see sweeping changes. I wonder whether Albanese will try and retain being PM or whether someone like Jim Chalmers will step up.
They'll
Because
do a bit of a
apparently Jim,
succession planning.
yeah, because there is rumors that Jim Chalmers actually has a lot of support
Mm.
within the party. So he could be as part of the succession plan if Albanese or Albo just gets over it. And that could be a good way for, I guess, keeping the votes rather than Albo. But yeah, I just think we are going to see some interesting proposals over the next couple of years coming out of the budgets.
Right, spot on, spot on. So for the young folks out there, the TLDR is with an ineffectual opposition. Labor is going to have a bit of fun.
Yep, absolutely. And now I want to move on to a couple of queries, questions provided
Yep.
from our listeners. Our first one here. Oh, hang on, I haven't got the name. Sorry about that. I'll just grab the name out of our Facebook group because that's a bit rude. Let's grab it right now. There we go. So question here. Where are we from? Jeff, Jeff Nicholson. Thanks, mate. So question, how can I maintain my Australian FIFO job but be a taxation expat, please? Question mark. So might need to unpack the question a little bit there.
Look, I think long story short, he wants to live overseas and fly back into Australia and work in Australia, but permanently live overseas and be deemed as a resident overseas. Um,
Yep.
I hate to say it, but can't do it.
It's pretty hard. It's pretty hard. Yeah, I mean, you're not really cutting ties, I would say, with Australia. I haven't come across anyone that successfully held a FIFO job for one of the miners or anything like that, but they've treated themselves as a non-resident. I just don't know if that exists, to be honest,
The
whether they're
problem
living
is,
over in...
yeah, sorry, mate. I was going to say the problem he's got is his work's being consumed in Australia. So,
Yeah,
and as we have seen from the ATO time and again, if you work for an Australian company and your work is consumed in Australia, regardless of where you live, you're an Australian
yep,
tax resident. You could be living in Dubai or Hong Kong or Singapore working for an Australian company, but if you're
yep,
working for and that work is being consumed in Australia, you're a tax resident.
yep. Well, I mean, don't get me wrong. Jeff can be a tax resident, live out of Bali, keep his cost of living down,
Yeah, and offset.
and save well.
Yeah, it'll offset
Like
his
say
expenses. Yeah.
exactly, save well, invest the difference compared to maybe renting a house back in Australia and having the same expenses that we all have. So that's an option. You can be an expat that way, but you'd still be an Australian tax resident. So pretty difficult. So can't really give you the solution there on how to do it because it's not really, I guess, a thing, to be honest.
No, exactly. And I think, look, there might be some wriggle room under the new proposed rules if we do see an amendment to what the Board of Taxation recommended. But as of this present place and date of time, no bueno, as they like to say. No good.
No plano at all. Moving on to the next question here that was submitted by our online feedback form and podcast question form, actually.
Down the bottom, guys, if you've got any questions, Ask Atlas is the section. So fill that in and, you can be like David. Mate, it's a question for you. So I'll read it out and you can pontificate and give us your esteemed experience and advice. Hello, Brett and James. Reaching out with a question regarding IRS classification of employer and personal super contributions. This is always a juicy one for US expats. Wife and I are trying to make a decision about making additional concessional and possibly non-concessional contributions to super. Being US tax residents, we want to be careful not to treat classification as a foreign grantor trust. Wife has an industry super fund. I have a retail super fund. These both qualify as employee benefit trust classifications. Our goal is to
Hmm.
max out our super contributions. I won't go into too much detail because obviously we're only got a limited amount of time. But he wants to know, how does he max out his super contributions without personally contributing more than his employer and therefore
Yeah.
triggering a change in the fund classification? I think he sort of answered his own question, but mate, I'll hand it over to you.
Yeah, I'd say, David, you're obviously very well researched here as well because you've looking at the question, you're throwing out some really good terms. So I love to see it. I think the issue with the US tax system as well, it actually comes down to the accountant that you are using and the definition and their own treatment and interpretation of the law. Because typically Australian super is going to be treated as one of two trusts. It will be treated as an employee's benefits trust, and uh, you will pay tax on the growth of that if you are a highly compensated employee. That usually means your income's over a certain threshold. The threshold's about 120,000 US roughly. The other side is it would be treated as a foreign grantor trust. Now, it will be treated as an FGT and foreign grantor trust if it's a self-managed super fund. There's no getting out of that. And that does require extensive reporting. You will be paying growth on the contributions. You'll be paying tax on the contributions to the super fund. You'll be paying tax on the growth of within the fund, but you also have to do PFIC reporting as well. So it does mean your tax administration burden is quite significant.
Yeah.
Employee benefits trust, not so much. It's mainly just the growth of the fund, and you will pay tax on that. When we look at how the accountant will look at the fund, if more than 50% of the balance has been borne about your own contributions being non-concessional, personal, salary sacrifice, then it would be treated as a foreign grantor trust. Just because you contribute more in 1 year doesn't automatically deem it to be a foreign grantor trust. But David, you could also consider an alternative strategy here. If you're not going to be connected to the US in the future, and you're just on let's call it a simple E3 visa or an L1 visa, so temporary work visa in the US, you could look to at least invest the cash that you want to contribute via way of a non-concessional contribution outside of super, and use it in a straightforward investment portfolio that's relatively tax efficient. It's non-tap, so it's non-taxable Australian property, so it'll grow tax-free. And then when you come back, why don't you look at then considering a non-concessional strategy? You don't have to worry about the US, the IRS, and their long, obviously, tax tentacles. But as you know, or hopefully you know, we've actually got a very large contribution cap, 120,000 each per individual within a family. So if you're looking to make an extra, say, 15,000 per year in non-concessionals, why don't you just contribute that to an investment portfolio? And then when you return, you can then collapse that into your super, which will be rather tax efficient. You're not locking yourself for all that capital away either for maybe other maybe purposes or goals or objectives. And then when you come back, you can fold 120 in, or you can trigger the bring forward rule and fold in 360. It does depend on the size of your balance as well. If you're getting up to the transfer balance cap, you definitely need to be mindful of that. So I think there's a couple of ways you could rework that. So you're still building up a retirement asset without falling foul of the IRS. And it obviously just comes down to timing. Maybe when you're getting out of Australia, you do mention that you do plan to come back to Australia, return to live. So that tells me that when you come back, there would be an opportunity to fold this money into super then, and that way you're not paying extra tax to the IRS. No one likes to be their number one donor. But a really good question. I love seeing people that have actually done some really good research because it means you can have a really good discussion with them.
Now that question just personifies strategy, doesn't it?
Yeah.
Demarcating timeframes and everything, and it's beautiful because when you look at these different scenarios, do A between 1 and 2 and do B between 3 and 4. Simple as
Yeah.
that. And doing that gives you that tax optimized result. Also, too, it enables a bit of flexibility too. You've got optionality. Once it is in super, it's like the mafia, once and never out. You might choose to not put it in super. Who knows? But as you
Yeah.
say, if he runs an investment account out of Australia, non-tap, make sure it's PFIC compliant, then on any unrealised gains, you don't pay any tax to the IRS. You land in Australia, deemed acquisition, tick the box. You're now an Australian tax resident, so Uncle Sam has no say, and then you can sell down the portfolio, roll it into super as an NCC using a 3-year rule. Plus, sometimes clients will love to use the 5-year catch-up concessional as well. Boost that balance, meaning you get close to $1 million into super now. So yeah, happy days, mate. Mate, I think we'll leave it there. Thank you for both those guys for their first questions in the Ask Atlas for 2026. So every episode, guys, we've got to um, run these Ask Atlas putts. So please keep putting your questions in, whether it's via the form below in the description, via the Facebook group. Bit of housekeeping. Obviously, we have our seminars happening next month in New York and San Francisco. Hence why James and I were looking at the weather in New York, not because we're weather mavens, but to me, it's those sort of things. It's good to see what's coming down the line. So make sure you register. We'll put links in the events tab below in the description. And yeah, obviously book was launched this week. So thanks for everyone who started to sign up. Guys and girls, I promise you it is a value read. Everyone will get something out of this. So there'll be a link in the description below. And James, I think we'll leave it there and leave the good folks to get on with their day.
Absolutely, mate. Way to wind it up for today's episode. In the meantime, guys, can't wait to jump on the next episode and unpack a few exciting things around tax. Brett, as always, thanks for your time and see you on the next episode.
Thanks, James. Thanks, guys.